let's first get a look at the global picture. Taimur Beg, what's the picture you get a day after the IMF suggests that the global recession could deepen? Is there a sense that, at least in the short term, the next 3 to 6 months, things will get worse before they get better?
There are two ways of thinking about it. From a global markets perspective, which is what I do on a day-to-day basis, clearly the prognosis is not very good, whether it is you're looking at it from the perspective of the fixed income investor who is holding bonds in which there might be losses because rates are going up, or from the perspective of an equity investor who will probably not be able to see very strong returns from their equity portfolio because, again, of this slowing growth, rising rates narrative. But that's the market side. Some people care about that, but maybe lots of people don't. Then there's the economic side where we are talking about jobs and inflation and wages, where at least the cue from the US is the Federal Reserve is not going to relent till there is some crack in the labor market, there is some softening of wage upward pressure. That's not happening yet, and hence rate hikes likely to continue. 75 basis points in the November meeting, perhaps another 50 basis points in the December meeting. And we have to sort of reckon with that sort of dynamic. High interest rates, unlike we've seen anything like for about 15 years.
Jonathan Benetton, do you also see that at least in the next couple of weeks, particularly in the United Kingdom, which seems the most hit at the moment, among the most hit by the global economy, things could get worse given the energy crisis?
Yes, the United Kingdom and other parts of Europe generally have been hit particularly badly by, as you were saying in the introduction, by the energy crisis, which is both putting downward pressure on economic activity, but also putting upward pressure on inflation. Faced with that, central banks in Britain as well as in the United States have been raising interest rates. As you said in the introductory piece, if interest rates go up, particularly in the United States, that tends to put upward pressure on the dollar relative to currencies like the Indian rupee. And so a country like India is hit by a slowdown in the global economy, but also upward pressure on interest rates, upward pressure on prices. Again, as you were saying in the introduction, as the rupee falls, that would tend to, unchecked, raise inflation in countries like India as well.
So in a sense, therefore, Prasenjit Basu, Chief Economist at ICICI Securities, we've already seen the World Bank slash India's projection between July and October now by 6.5%, the latest number. Is this now a reality we must face, that we can't be fully isolated from what's going on across the world? There's been a sense that, look, we are relatively better off. That's the general impression the government gives. Having said that, do you believe that we need to, in a way, now look at the situation with a little bit more concern, given that this global recession appears to be deepening?
Well, first of all, the global recession hasn't yet hit. If there is a recession, we have stagflation in Europe, including the United Kingdom, but the United States is still growing. I mean, the U.S. economy is still doing well as far as the labor market goes. If you look at the labor market, they're still adding jobs. So the U.S. is not really in recession yet. The recession is still to hit. I'd say it's about 2 or 3 quarters away. But India is a relative island of calm in this global storm. India, yes, the growth rates have been reduced, but India is still going to be growing over 7% in the current fiscal year. That is easily the fastest growth rate in the G20. There is in the G20 another economy that is doing very well, and that is Indonesia. Indonesia is a commodity exporting country and is in robust health as well. But with the exception of India and Indonesia, across the G20, the 20 largest economies in the world, those are the 2 islands of relative stability. Elsewhere, you have a really difficult period ahead, and basically the United States has made a massive monetary policy error, and they're having to correct that rather aggressively now. And as they do that, they are driving the U.S. economy into a recession by the middle of next year. So the prospects are not great for the world economy. But within that, I think India's strength is that India has deleveraged both internally and externally. If you look at external debt, India's external debt as of June this year was up just 38% relative to March 2014.
Yes.
So that's a very modest increase, not even the same sort of pace of increase as nominal GDP over that period. In the previous 10 years, 2004 to 2014, India's external debt had increased by 296%. So, so we've deleveraged. We are now deleveraged externally. We've deleveraged domestically. Nominal loan growth has barely been 9% on average every year for the last 8 years. So very, very modest loan growth. The economy has deleveraged domestically and externally, and as a result, India is in relatively good shape. You're able to deal with this crisis a lot better than most other economies.